Auch die letzten Jahre hat uns das unendlich lange Zinstal schon beschäftigt. Und wir wollen auch diesmal einen Block diesem Thema widmen. Beginnen wir wie immer mit dem Griff zu unserer TED-Umfrage. Wenn Sie das Gerät zur Hand nehmen. Der JP Morgan Emerging Market Bond Index, Global Total Return Index, hat in 2013 mit minus 6,6% eine enttäuschende Wertentwicklung geliefert. Die aktuelle Yield to Maturity liegt bei 5,48. Welche Performance halten Sie für die kommenden 5 Jahre für realistisch? 1 unter 0, 2 0 bis 2%, die 3 2 bis 4, die 4 4 bis 6%, die 5 6 bis 8 oder die 6 über 8%. Ich bitte Sie um Ihr Votum. Total Return, Kurs plus Zinsentwicklung. So, da haben wir das Ergebnis. Wir haben eine Mehrheit bei der 4 bis 6%, haben dann eine starke Besetzung bei 2 bis 4. Wir sind doch alle gut dabei, uns auch an kleinere Zahlen zu gewöhnen. Und sehen ansonsten, ja, nochmal 0 bis 2, unter 0 doch nur sehr wenige, aber auch sehr wenige nur mehr als 8%. Das ist jetzt keine Normalverteilung, sondern eine links schiefe und rechts steile Verteilung, die wir hier haben. Sehr schön. Ja, kommen wir zum nächsten Referenten, zu Mr. Arvind Rajan. Ich freue mich sehr, dass er bei uns ist. Er ist Managing Director und International Chief Investment Officer bei Pan-America Fixed Income. Über 20 Jahre Berufserfahrung im Fixed-Income-Bereich und was ich sehr bemerkenswert fand, 2-mal Platz 1, einmal Platz 2 bei dem jährlichen Umfragen International Investors Magazin macht das ja die All-American Fixed Income Research Polls. Das ist schon sehr beeindruckend da, 2-mal Platz 1, einmal Platz 2. Ja, und er ist Co-Autor des Handbuches The Structured Credit. Auch das haben Sie vielleicht schon mal gesehen. Also hochinteressant und ich glaube genau der richtige Referent für unser Thema Emerging Markets Debt Under the Cover. Please, Mr. Rajan. Take this and the green one starts your presentation.
Okay, thank you very much for that very nice introduction. And I'm very happy that I'm going at 4:30 in the afternoon because actually over the course of today, you've already heard a number of perspectives on emerging markets, including an extremely interesting and provocative presentation from Mr. Zulov earlier today. I think I will be presenting a slightly different perspective on emerging markets, and I think that perspective perhaps is based on the poll that we just did, is perhaps in tune with what the room believes. And along the way, my goal today is to dig under the covers to try to make to check. To do a reality check, to do a sanity check. Because if, in fact, the world is about to blow up, and there is always a risk of that, because we have all we must not forget that we have been through the 2008-2009 crisis. So those kinds of things can happen. China can blow up. So in the presence of those risks, does it make sense to be in what is probably the most difficult and risky class within fixed income assets? So that's really the question that I'd like to address today. And even if the baseline scenario calls for good returns, we must ask ourselves what the probability is that we could be wrong. And that is always what good investors ask themselves. So let us see if we can walk through the rationale for the investments. So let me talk about the key themes that I'll be touching on. The binary debate in emerging markets between bulls and bears is what we are all used to seeing in the newspapers. It's always either that a gung-ho emerging markets is the best asset class, it's the demographics, it's the growth, it's the future, jump in, or it's a minefield and it's about to blow up. And the reasons why it's about to blow up tend to change over time, but at the same time, they generally are based on good reasoning. And this debate occupies the headlines. The reason that this is the nature of the debate, rather than the type of work that we tend to do, namely the details. The reason that it's the binary debate that occupies the headlines is because that's the nature of headlines. It's the hedgehogs, rather than the foxes, as they say, that occupy, that are most newsworthy. You need a soundbite in order to be quoted. And if you don't have a soundbite, if you say it's complicated and you have to look into the individual countries, and yes, there's risk, that doesn't really gather that much interest from the media. But I will tell you that when it comes to investing, the details matter a lot. And that is really what I'm going to focus on today. Dig under the covers, go into the details, and point out that emerging markets are not a homogeneous asset class. Talk about how interest rates affect emerging markets, and look at the valuations today. Look at where emerging markets are trading in relation to their competitors, both in the developed world and also among riskier companies in the developed world, and ask whether there's value there or whether there's not as much value. So, as I said, the last year has been quite an interesting year from the standpoint of headlines on emerging markets. And it's interesting that these headlines were notably absent before the blow-up, starting with the taper tantrum. It was only after May of 2013 when people suddenly became concerned about the Federal Reserve pulling out of its bond buying program that all of the risky asset classes had a sharp correction, and emerging markets was hurt more than any other asset class because, as Mr. Zulov pointed out earlier today, emerging markets have indeed been the beneficiary of a lot of portfolio flows over the last 6 or 7 years. Those portfolio flows were undoubtedly aggravated or increased by the fact that developed market interest rates were low. And so when the sell-off happened, that really was a major bearish signal for emerging markets, and I will be showing you the returns that resulted from that in a bit. The reasons that are given for why emerging markets are very risky asset class and you should stay away from them are basically fivefold. And I'm going to address in this talk primarily emerging market debt, not equities. And however, that's a rich asset class by itself. Emerging market debt really has two big subsectors. There is a hard currency subsector that is dollar-denominated bonds for the most part, and then local currency bonds, which are issued in the currency of the countries that are issuing them. And those bonds have two types of risk. There is the underlying currency risk, and there is the interest rate risk of the local currencies, the local yield curves. So as a result, there's not a single analysis that you can do that says what the returns of this asset class will be. You have to look at them separately, and we'll look at both of those. It is also worth noting that the outlook for emerging debt need not be the same as that for emerging equities. So it is possible that emerging equities could have a fairly negative outcome, whereas emerging debt could do quite well. And to prove this, all that you have to do is look at the last 5 years or so of returns, when emerging equities have had a pretty bad run in relation to developed markets, and emerging debt, primarily because of its yield characteristics, in aggregate has done quite well over that same period. So the 5 arguments that I hear against emerging markets, the very first one has to do with the taper. But now that the taper has been absorbed by markets and everybody is comfortable with the taper, it has gone on to the next level, which is that interest rates in the developed world have to rise. The second is that emerging markets are not the story that they used to be from a fundamental perspective. The growth is coming down, and China is leading the way, but emerging markets as a whole are also slowing down. This is true. However, you have to ask whether that's a reason not to own emerging debt. Thirdly, that credit quality in emerging markets is precarious. We all know that Argentina is in the middle of a very public debate about whether or not they should default on their bonds. Given that's the case, it is easy to extrapolate from Argentina to the rest of the asset class and say, you know, these guys are not that reliable when it comes to paying you back. China is risky. I would not question that China is risky. China is a risky place, and it has indeed had many of the issues that Mr. Zuloff pointed out. But I will try to make the case that it is not necessarily a reason to run away from emerging market debt. And finally, I can get yield elsewhere. I don't need emerging markets. Is that really true? Let's look at the valuations at the end and see if we believe that. So that's the outline of the talk. So let us start right away with the interest rates. So we know that the yield curve in developed markets is one of the steepest that it has been for many decades. One of the consequences of that steepness is that the market is already factoring in a very sharp rise in interest rates over the next 5 years. So what I show you here in the picture is the 5-year forward yield curve for the US. As you can see, this is as of March, and it has come down a little bit since then, but still, you can see that the bulk of the forward yield curves on US swaps is above 4%. And if you were to redo this picture as of today's yields, then you'd find that it's down by a few basis points. But basically, the long-term average Fed funds rate, which is implied by the US yield curve, is more or less in line with the discussions that the Fed itself is having internally and in the public about the long-run convergence of rates. So there is no surprise in US interest rates with respect to the general consensus about rates rising all the way to 3.5% to 4%. Now, is this realistic? And here, I have complete agreement with Mr. Zuloff. The world is a slowing place with respect to growth. You have a number of structural factors that may make the future different from the past, and that may, in fact, mean that after a very long period of declining interest rates, that you may not have a rise in interest rates back to historical levels. Instead, what is more likely is that interest rates will remain in a low and range-bound state for the long term. So these structural factors include, of course, demographics. An aging population was, in the past, always thought to give rise to inflation because there are fewer young workers and there would be then a shortage of labor. But what that failed to take into account was the spending patterns of the old. They just don't spend as much. And there's plenty of empirical evidence that's accumulating, and Japan is a great example of this, that you actually have a slowdown in consumption as the population ages. There's also structural issues with respect to the equality of wealth. Of course, all of you have heard about Piketty's book. I myself am on page 150 or so of this book, which is extremely well written, by the way, and if you haven't yet read it, I recommend that you read it. It is a very nice summary of about 200 years of wealth and income data that indicates rising inequality in both. And that rising inequality is likely to lead to a depressed interest rate environment and low returns on capital for some time, because there's a lot of capital chasing relatively few opportunities. There is also a structural downward pressure on interest rates coming from the leftover effects of the European crisis, as well as the global financial crisis of 2008, 2009, which has left the developed markets in an over-leveraged state. And that deleveraging process is going to be a brake on growth. As a result, the G4 central banks are likely to be in an easing mode for much longer than we expect in order to counteract the slowdown caused by those crises. And then you also have inflation. So when you have a disinflationary push from China, but also these days from the likes of India and Vietnam and Bangladesh and Mexico on goods prices, that means that the inflationary forces that we are used to seeing in the 60s, 70s, and 80s are not realistic with respect to the future. If you take those out of the distribution of US rates, you would find that US rates have been between 2.5% and 4% for most of the history for the last 200 years. And I think that something like that is the likely outcome going forward. So the very threat of rising interest rates is not only factored into the curve, but it might be over-factored into the curve. Now, when it comes to buying emerging markets, you have to compare their yields to that of the US. When you do that, you find that by and large, these emerging markets, and I've given you a sampling of 10-year yields, are much more attractive than the US. And the country's budget deficits, although negative, are all coming down because of the force of the markets. You know, as more foreigners buy these bond markets, they enforce market discipline. So last year, for example, after the taper tantrum, you had a big sell-off in local rates, and that forced most emerging markets from an easing bias to a hiking bias in interest rates. So where the Fed, the BOJ, and the ECB, and the Bank of England all remained very accommodative, the emerging market central banks were forced to raise interest rates and bring the interest rates up to a point where the average real yield of emerging market local debt is about 2% compared to very close to zero in the US. So, and of course, they do have budget deficits that need to be funded. So you could think of that real yield as a risk premium that you're being paid in order to finance these countries. And indeed, I think emerging markets as a group will probably require financing on the private side for many, many years to come. That's not to say that the governments need a lot of financing from the outside. That is actually not the case. But the private side of the emerging markets are going to need a lot of funding. And as they continue down the path of raising that financing, there will be a lot of opportunities in private emerging debt in these currencies. But these currencies, the yield curves of these currencies, in my opinion, represent an attractive investment alternative to developed markets, and they have less sensitivity to US interest rates than, obviously, G3 bonds. So the question really then becomes one of credit quality. Are we buying something that is going to pay me back, or am I buying something for which I'm not adequately compensated for the risk? And we'll address that next. Now, what about growth? We heard from Mr. Zoloff, again, that growth is likely to be very slow going forward. I happen to agree that growth will not accelerate to the levels that we became used to in the 60s and 70s, and it will not even accelerate to the levels that we experienced in the mid-2000s. In the mid-2000s, the growth was fueled by a tremendous credit boom in the US, as well as in Europe, where assets, particularly housing, but also other assets, were pumped up. And that pumping up process added a lot of GDP. Hopefully, we've learned our lesson from that, although I'm not convinced that we have. And if you take that out of the equation, the long-term growth rates are, in fact, going to be quite modest. If you look at our forecasts for global growth, though, you find that 2014, by and large, is better than 2013, except in China. So we were very early to call a Chinese downturn, and our growth forecast is considerably less than the average, and that represents the adjustments in China that are going to be required in order to get out of the over-leveraged credit situation that we heard about this morning. But if you take China out of the equation, then emerging markets, which are flat relative to last year, are probably going to grow a little bit, similar by about 0.5%, similar, in fact, to the US, Europe, and Japan combined. So, in fact, emerging markets are not slowing down at the moment. They're actually getting better. In the long run, they will grow more slowly than they did in the past, but as you'll see in a minute, much faster than the developed countries. So growth in emerging economies continues to exceed that in the US, EU, and Japan, whether or not you include China. If you include China, the numbers will be higher. If you don't include China, they would be lower. But one of the facts that is overlooked in the debate about flows is what this growth has actually done to the size of these economies. At this point, the emerging economies are already half, in a PPP sense, that is price parity sense, to the developed world in terms of GDP. So the stock that you're looking at is comparable in size to developed markets. And in terms of the flows, that is going to attract, at a higher growth rate, more investment than the developed economies. So if you look at your allocation to emerging markets, it is very likely that it's significantly less than the GDP weights. Now, even in nominal terms, GDP should be a third of global GDP, and almost nobody has a one-third weighting in emerging markets. So over time, that smaller allocation, or whether it's 5% or 10%, should be growing as it catches up to GDP. What about the quality of the people that you're lending to? I said earlier that probably emerging market bonds are offering you, in local terms, a better yield than the developed world. And if you don't worry so much about rising interest rates, because rising interest rates, just as last year, will in fact cause a shock to emerging market debt. But if you think that interest rates will be reasonably controlled over the next several years, then emerging market debt would look attractive if it were not for the credit. Well, the credit of emerging markets is very different than what it was 20 years ago. In fact, from a balance sheet perspective, most of these countries are now investment grade, more than 60%. And even though you see an increase in the single B category, which is, let's see if I can get this, which is this gray piece right here. You see an increase here. Most of that comes from an addition of new countries to the mix from the bottom. So new countries are entering the mix of emerging markets, and they're issuing more debt. So, but that is overwhelmed, in fact, by the improvement in credit quality that we have seen pretty much continuously for the last 20 years. I see no end to this improvement. I actually see credit quality in emerging markets staying either flat or improving over the next 5 to 6 years. As a result, there will be very few defaults, if any, in emerging markets that is rated single B or higher. If you look at emerging markets rated double B or higher, there will be no defaults in any sizable country that is rated that. Small countries could have crises, but the bigger ones are too big. And we'll see in a minute that they're positioned extremely well financially. One of the reasons there will be no defaults on external debt, at least, in emerging markets that are large, is because of their reserves. We have all heard about the currency wars, and one of the effects of QE has been to push a lot of investment towards emerging markets that would not have otherwise gone there. In order to prevent their currencies from appreciating too much, these countries have adopted pretty aggressive policies to accumulate hard currency reserves. And those reserves are now of the order of $12 trillion and increasing. Even when you take China out of the picture, China accounts for more than $3 trillion of that total, the other countries still have very large and sizable reserves. In fact, if you look at the total financing requirements of emerging markets over the next year, and this is both public and private, so it is all companies and governments that have borrowed abroad in hard currency, and how much they have to pay back over the next 12 months. Supposing you had a sudden stop, and capital stopped flowing into these countries, and nobody was willing to refinance them, would these countries be able to pay back all their debt from their reserves? Well, if you look at the reserve picture, the reserves to GDP is at an extremely respectable 10% or higher, and in many cases, it's above 20%. And as a result, what you're going to find is that it's very difficult to get these countries into a position where they cannot refinance themselves. They will simply draw on their reserves. It will take a very prolonged and deep crisis to plunge these countries into a state where they are not able to pay their reserves, their debt back over the next 12 months. So this last column here shows you the ratios of reserves to refinancing requirements. And you can also see here that there is a very substantial difference between one country and another in this picture. The countries that look somewhat vulnerable in this regard include such countries as Hungary, Turkey. Turkey has the lowest ratio here, and it is for that reason that when you had the big taper tantrum last year, that Turkey, among all of the countries, had to raise the interest rates the most. They raised their interest rates by almost 5%. But what happened when they did that? The capital flows that had started to go out of Turkey stopped. So the capital flight stopped, the situation stabilized, and now Turkey's central bank is in a position to start cutting interest rates, and you will find that they're going to cut interest rates a few times for the rest of the year. So this highlights one of the key elements of emerging market vulnerabilities. When they come to the forefront, as with the taper tantrum did last year, these countries find themselves immediately having to adjust to new market conditions. The market immediately reprices their cost of capital. And emerging markets, after having been through the crises of 1994, 1998, 2002, and 2008, these have been frequent enough that any politician in any emerging market cannot afford to ignore them, even within the span of his or her own political career. 4 years out, they are coming up for re-election. They do not want to have been the ones that blew the country up. So they adopt pro-cyclical policies to defend. What does a pro-cyclical policy mean to investors? Very simple. It means higher yields. You get higher yields on your investment instantly. And so what is your reaction at that point based on the media? Cut loose and run for the exits. What is the right reaction at that point? Usually, and I'll point this out to you, it has been, give me more. So what is the impact of the higher growth that we have experienced in emerging markets over the last 15 years? You have large, young populations. We haven't talked about demographics, but emerging markets has much better demographics than the developed world. And as a result of that, you have had decreasing federal debt as a function of GDP. If you look back at the emerging countries back in the early 2000s, you had typically debt to GDP ratios in the 60s, although the average was lower. But many countries, the Fragile Five in particular, except for China, had very high debt to GDP ratios. But over time, that has come down, and now that number is somewhere in the 30 framework. So they've halved their fiscal debt to GDP, which explains the earlier chart which showed you that their credit is much better than it used to be. Along with that, a less well-known fact is that the savings and investment rates are actually much, much higher than they are in the developed world. So countries like China, India may be fragile, but they have enormous savings. And those savings are trapped in those countries. They don't have anywhere to go, which is the reason why China has had the over-leveraging that it has experienced, is that all of that savings is trapped in the country by policy and then channeled in certain cases into investments that will not return what they used to return in the past. But it also has a silver lining, and that silver lining is that the savings rates have historically exceeded their levels of investment. And so you have a contribution to growth that comes from that, which is basically absent in the developed world. And because of these improvements in credit, the risk of contagion, where all these emerging markets suddenly come under risk of capital flight and they all sell off together, they still occur, but they are less volatile in magnitude. So you can see that if you sort of look at how the each sell-off has been in relation to the past, you find that the amplitudes of those sell-offs have decreased as the credit quality has improved. Now, I don't want to minimize the risk from China, so let me spend a little bit of time talking about that. China is, in fact, under many of the risks that Mr. Zulov described to us this morning. They, in fact, have a very ticklish problem, which is that they've got slowing growth, and at the same time, they have been investing too much. They have excessive domestic credit building up, and that domestic credit has been the primary driver of growth. So they have a very difficult policy choice, because in order to reform the economy and convert it into a consumer economy, they have to live with lower growth and fewer jobs being created. This is a very difficult political move, and in order to accomplish it, the current leadership in China has to consolidate power. The consolidation of political power, as you all know, is a difficult process in any country, and China is no exception to that. So the anti-corruption drive that we see in China today is, in fact, a behind-the-scenes move to consolidate power and bring it into the hands of Xi and a few of his trusted colleagues. The other components of reform, which specifically include, when I talk about excessive credit in the private markets, what am I really talking about? I'm talking about 240% of GDP, most of it piled up in the last few years, of private credit. Most of this is bank credit, but there is also a very large shadow banking system. Remember the shadow banking system in the US that built up in the mid-2000s? Well, we have a subprime-like problem in China today. And that consists of something like 30 or 40 trillion renminbi worth of wealth management products, trust products, bank-affiliated but not really bank recognized lending, and retail lending, which is done over the internet. So there's a lot of private credit channeling savings which are trapped in the country into corporations which are largely affiliated with the government, either the central government or the state governments, Now, this has to be stopped. This has to be slowed down. This has to be brought under control. But the process of doing that will require, and this is a command and control economy. Make no mistake that this exists because the policy makers, the authorities, want it to continue. But they are afraid to rein it back too quickly because it will stunt job creation in an economy which has been used to churning out a very large wage increase as well as job creation for the last 20 years. But it will have to be done. And that process will be, I would suggest to you, much more painful to the Chinese than it will be to us. Because China, even though you could make comparisons to all the other countries which have been through similar over-leveraging and deleveraging cycles, is a very different cup of tea. As I pointed out earlier, China has $4 trillion of US reserves. If they chose to depreciate their currency, and if as a result, some people were to take their money out of China, they have plenty of room to pay those people off. Much more than any other country historically has ever had. Japan is a good example of a country with a very high current account surplus, and they used that current account surplus to insulate themselves from what would otherwise have been a very messy credit situation. We all know that Japan's government debt to GDP is more than 200%. It's much higher than any other developed country. But we also know that many people have lost their fortunes betting that Japan is going to blow up. Why hasn't it happened? It's because of the extremely favorable external situation and the fact that all of that over-leveraging has happened between the private and the public sides of the Japanese domestic economy. Much the same is true in China, but with the additional advantage that it's a command and control economy. So it's one that's controlled by the Chinese. And so they have a couple of different paths that they can pursue in doing this. And if they pursue the right path, they will start to rein in credit right away. And this will probably take a hit to growth sooner rather than later. They should then liberalize the financial sector. The problem that they're having is that the left arm and the right arm move somewhat independently, even in a place like China, which is centrally controlled. And there are some very powerful interests that want to preserve the old investment-driven model that are essentially owners of the SOEs, the state-owned enterprises, that are collecting rent from this differential between the savings rate and the return on investment as long as it lasts. And they are very resistant to change. If that resistance cannot be overcome by the leadership, we will have a hard landing, a harder landing, more in the direction of what Mr. Zulov suggested. But for emerging market investors who are not primarily in China, and in fact, for example, in our portfolios, we have very minimal exposures to China, the question really is, what is the vulnerability of our other emerging market investments to Chinese exposure in the event of a Chinese hard landing or slowdown? When you look at those numbers, and there's a lot of numbers on this chart, so let me apologize, but I thought that you should take away some of the details here, because the details really matter. The first 3 columns show you the trade percentage with China, and as you can see, it's quite substantial for many of the emerging markets, but not overwhelming. So in most cases, under 15%. And if you look at the commodity exports to China, which are the most problematic of the connections, because a rotation from investment to consumption is going to especially cause a big drop in the usage of industrial commodities, coal and iron ore being 2 big examples. And you can see that in recent days in the market, both of those have tanked in price by about 50% compared to where they were a few years ago. But the actual exposure to those commodities, the industrial commodities, is only a fraction, typically a third of the total commodity exports. So commodity exports, which are listed over there on the right-hand side, consist of metals, agriculture, and energy. And it's primarily the metals complex that is subject to the slowdown in China. Agriculture is going to actually improve, and many emerging markets export a lot of agricultural goods. So it is possible that what you take away with the left hand, you may be giving back with the right hand. And with respect to energy, it's not clear that Chinese energy needs will drop a lot. And as a result, oil is still quite strong. So I think that you could take a slowdown or a rotation in China to be something much bigger than what it might actually turn out to be with respect to its impact on the world. That is clearly not going to be the case if the Chinese mess it up. In other words, if they hold off for too long, they let the credit bubble build up for too long, and then the whole thing is pricked and you lose confidence and you get an enormous property correction, you get an enormous correction in the value of the banks, which, it is true, for example, that the true level of non-performing loans in Chinese banks is probably about $1 trillion, about the same as the subprime problem in the US. But banking problems don't have to lead to banking crises if you don't rely on the capital markets for funding. The government has plenty of room on its balance sheets to take the banks on, to essentially recapitalize them, nationalize them, whatever they need to do in order to plug that hole. So there are ways out of the Chinese crisis that will simply lead to a slowdown in growth and not a blow-up. Let me conclude by talking about valuations. So I said at the beginning that everything in risk has to be matched with the corresponding question in valuation. If the risks are elevated, are you getting paid for those risks? Well, the taper tantrum is behind us, but the valuations in emerging markets are still cheap. And if you look at the emerging markets versus BBB corporates, you can see on the right-hand side, the dark line shows you that they are at near the decade wides versus corporate investment grade debt. If you look at only safe countries, in other words, countries that are rated investment grade all the way to AA, the spreads of those countries, which are in this column here, just take a glance at that and ask yourself, why are these countries trading at spreads that are in triple digits when the bulk of industrial spreads in Europe and US are well below 100 basis points? It is this risk premium and this fear that we talked about earlier that keeps those at cheap levels. This means better returns for you in hard currency space. So I'm in the 6 to 8% camp on the survey that we did on the returns to EM. If you look at spreads to high yield, BB high yield now is flat to emerging markets. And as we saw earlier, emerging markets is largely investment grade. So you're buying a whole bunch of emerging market investment grade countries, primarily, at the same spread that you get for BB high yield, which to me is a bargain. If you look at the local markets, the local bonds, as I said earlier, give you about a 2% pickup relative to the developed market rates, because the developed market rates have come in so much. And so to kind of summarize returns in local markets, the first component would be the real appreciation of currencies. Currencies have a 10 to 15% volatility. They probably will, and they have yields in the front end of 5 or 6%. You'll probably get 2% of that in the form of return in emerging markets over the next 10 years. So 2% returns from the currencies. You'll get another 1 to 2% from the yield curve, that is the term premium in the local market. And you will get another 1 to 2% from a reduction in inflation over the course of the next 10 years. So you're talking about 5, 6, 7% returns, depending on the country, in emerging market local debt over the next 10 years, a very decent return for debt. Remember, this is debt, not equities. And if you look at sell-offs, they tell you that every sell-off that we've had in emerging markets has been followed by a strong rally. The reasons that I outlined in the talk are the reason why. This is hard currency, dollar bonds. These are local currency. And we don't have time to look at the numbers here, but if you look at the charts at your leisure, you will find that in almost every case, within 12 months, the asset class bounced back after a sell-off. And after having been a veteran of EM since the early 90s and experienced the tequila crisis in Mexico in '94 personally, on through all of the different sell-offs, and we can count 12 to 14 sell-offs in EM, I will tell you that sell-offs are not the time to run away from emerging markets. they're time to get in. So what did we conclude? Interest rate increases are largely priced in. Global growth is firming in 2014, and although it's slowing in the long term, EM is still stronger than DM. Emerging market credit metrics are pretty strong. China risks appear to be manageable, provided the Chinese don't wait too long to correct their over-leverage problem. And finally, emerging markets do look cheap versus other fixed income alternatives. Thank you.
Thank you very much, Mr. Rajan, for this insight. Are there any questions? To emerging market debt. Herr Kleberg.
Thank you for your interesting presentation, Dr. Rajan. What sectors in emerging market debt do you think are the most attractive? Hard currency bonds, local debt, or corporate bonds?
I would rank them as, in terms of information ratios or Sharpe ratios, as hard currency first, corporate second, and local currency last. However, in terms of total return, I think that local debt has the highest potential for returns, followed by corporate and hard currency. So there's no free lunch. If you want higher returns, you're generally going to get slightly less information ratios. But I think all three are attractive. And if you looked at the efficient frontier, you would usually use a mixture of both hard and local. So I've done studies like that for several of the developed countries, using their own currencies as the funding currency, and a stock and bond mix of European or Australian or US stock and bond markets as the starting mix. And when you do that, you find that, first of all, the emerging market characteristics, and I'm using forward-looking projections, not historical numbers. Historical numbers are too rosy. But using forward-looking, more reasonable return and risk expectations, you would find that that there are different points in the risk spectrum where you own only hard currency if you are very risk averse. You would own a mixture of hard and local if you're willing to tolerate something of the order of incremental risk of 1 or 2%. And then if you're very risk loving, then you would own all local.
More question. I don't see anyone. Then, thank you very much again.
Absolutely. Thank you all.